And so a very interesting conversation in the economics, to be specific, macro econ is what we have. And so today we're continuing looking at the money or credit multiplier. Money multiplier or credit multiplier is just one and the same thing. It is basically the multiple by which the deposits can increase for every quarter increase in reserves. Observe that I'm using the local currency, kwacha. So the multiple by which the deposits, that is to say the total supply of money, can actually increase for every increase in reserves is what is called the money multiplier, okay? It is equal to 1 divided by the what? By the reserve ratio. So this is how you find the money multiplier. You just say 1 divided by the what? By the reserve ratio, 1 over the reserve ratio, okay? Once you divide 1 divided by the reserve ratio, then you can easily get the money multiplier. Someone is asking, what is the reserve ratio? So a reserve ratio, it is basically the fraction, okay, of money or the percentage that should remain in the bank for every deposit. So whenever you make a deposit to a bank, there is some money that should remain at the bank to meet the demands of the withdrawals, okay? When you go to withdraw money, there should be that fraction that the bank should leave so that you can manage to withdraw. And the other fraction is regarded as the loanable amount. So the loanable amount is actually the money that can easily be loaned out. So the bank usually does use the loanable amount to give out the loans. And once they do give out the loans, so you find that that money again goes into circulation. So that fraction is usually dictated by the central bank, that every bank maybe can leave at least 20% as the reserve ratio. So it simply means that each bank is mandated to keep at least a 20% of every deposit. If you deposit, for example, 100 kwacha, then the 20% of 100 kwacha, which is 20 kwacha in this case, should remain at the bank, should never be given out as the loanable amount. Then the remaining 80 kwacha will be treated as the loanable amount. So the bank will give out the loan worthy 80 kwacha and make a deposit to someone's account. Every time the bank makes have a deposit, a certain fraction remains as a reserve that is added to the total reserve like that. Is that clear? Okay. All right, so Mr. Msunga, you will be answering as well if you're okay where you are. Is that okay, sir?
Yes, sir. Though I'm on the road, but
okay, it is well. Okay, I won't be asking so much, but just be following the recording, the recording process. Let's look at the numerical example of the money or the credit multiplier. So the change in deposits, which is given as delta D, okay? The change in deposit is given by the formula, all right? It is given by the formula, and the formula is the change in deposit. It's always given to the reserve ratio. Let's say this represented by D multiplied by the change in C, whereas the change in C is the initial change in cash reserve of the commercial bank. So when someone deposits some money, they make a deposit. That is the change in C, in cash. Then that cash will be multiplied by the what? By the multiplier, which is actually the money multiplier. This one, the money multiplier, we said, is given as money multiplier D is given as 1 over the reserve ratio. Okay, so 1 divided by the reserve ratio gives us the money multiplier. So you have that fraction is the one that you use to multiply, and then you can have the the change in deposits. Okay, so for example, if you make a deposit of 100 kwacha, okay, then the total D will be 1 over, since we are given that the reserve ratio is 10%, right? You have 1 divided by 0.1. Okay, the ratio is 10%. So you say 1 over the reserve ratio, that's the multiplier, times what? Times the cash, the change in cash. So this 1 divided by 0.1 is basically 10. 10 multiplied by 100, the change in cash, gives you a what? 1,000. Okay, that is now the change in what? In a deposit. The change in deposit is basically the change in cash times the multiplier, okay, of which the multiplier said is the reserve 1 divided by the reserve ratio. Okay. Mr. Maza, how are you?
Fine, how are you, sir?
I'm all right, thank you. So I'm hoping that you're following.
That's when I've joined.
Okay,
yes, I'll follow.
you'll be fine. You'll catch up. You'll catch up. You manage to catch up. Right. Okay. So that's actually what usually happens. So let's look at this example. Let's suppose the monopoly bank, meaning one bank opens its doors to the public, monopoly bank, okay, balance sheet. So what happens is that they have got the cash here and the deposit. So there is the deposit is always a liability to the bank. I should underscore this again. The deposit, whenever you make a deposit is a liability to the bank. Why is it a liability? That deposit does not belong to the bank. It belongs to the owner. Okay, it belongs to the owner. It is not for the bank. So that's why it sits on the liability column of the cash account of the bank. So then the asset for the bank, okay, will increase by the same amount. It is a liability. It is a liability. The deposit is a liability. At the same time, on the other side, you have got the cash for the bank, because that cash can be used to do other things. Okay, it can be used to do other things. So that's why it becomes a liability, an asset on the other side. Now, the cash ratio is 10%. The bank can loan out $90 or purchase the bonds that are worth $90, or do a mix by diversifying, right? At the end of the credit creation process, then this is what is going to happen at the end of the credit creation process. Number one, you have got $100. You start with $100. Started with $100. As you started with $100, the $100 you had to multiply them by the cash ratio, the ratio which is 10%. It gives you a 10 kwacha, obvious. This 10 kwacha becomes a reserve, right? It becomes a reserve. So since it becomes a reserve, it is not the money that you will do what that will be given out as the loanable amount. So which means only 90 kwacha belongs to that bank, and that's the one that they can use to do other things. Now, the note is that the size of the money or credit multiplier is that the smaller the cash or the reserve ratio, then the greater is the size of the money or the credit multiplier. So if what is being said mathematically is this: we know that the multiplier is given as 1 over the required reserve ratio, right? So if this reserve ratio, the R down here, is small, what will happen is that this number here will increase, right? But if this denominator increases here, as the denominator increases, what will happen to the output? The output decreases, isn't it? I can give you an example of a number. Let's say you have 1 over 2. 1 over 2 is 0. What? It's 0.5, right? What if we increase this to this 2 down here to 5, right? If we increase this to 5, this will be 0.2. Okay, it has reduced, right? And so if what we are drawing, the conclusion we are drawing is that if the reserve ratio is big, then the multiplier will be small. But again, if the reserve ratio is small, then the multiplier will be what? Will be large, okay? Will be big. The credit multiplier or the money multiplier is the same name, it's just one and the same thing. Okay. So the reserve ratio, follow that one. That's very, very important. You need it when you start applying, when questions are brought. So what happens is that when the reserve ratio is small, then the multiplier will be so big, such that whenever you just deposit any little amount of money, it will be multiplied at a greater degree. And that is what usually happens. So the creation of bank deposit is limited by two factors. Number one, the bank's propensity to keep cash for liquidity. Okay, the creation of bank deposit is usually limited by, okay, the interest of the bank to keep cash for liquidity purposes, okay, or the public's interest to hold additional cash. So these are the two factors that influence people. I want to hold cash, meaning they don't want to deposit the money in the bank, okay? Then at the same time, it is possible that this same bank also want to keep cash, okay? Want to keep cash. They don't want to loan out, to give out cash as loan. So if you see that people are not depositing the money and the bank is not, is holding on to cash, is not giving out loans. So what will happen is that more money will not be sent into circulation. There will be little money that will be sent into circulation. And that, as a result of that, the creation process of the deposit will be what? Will be affected. So the bank itself can affect it if they want to keep more of cash, or the public itself, the people are not interested in depositing, they just want to keep money. And as a result of that, the creation of bank deposit process will be affected. This is very, very important. You need this unit. There are some of you who are going to do money and banking as a course. This is the foundation. Some of you are going to do monetary economics. This is also the foundation. Some of you do international finance. This is the foundation. So pay attention. You really need this. All monetary economies, they have the central bank, okay? For example, in the US, it is called the Federal Reserve Bank. Most of the books that you read in economics are from the US. So you find the Federal Reserve. The Federal Reserve is just the same as the central bank. For example, here in Zambia, our central bank is called the Bank of Zambia, BOZ. Now, the primary role of the central bank is to conduct monetary policy in order to influence the level of economic activity. And this involves regulating the supply of money and the cost and availability of credit. So that's what the central bank does. The primary role of the central bank is to control money supply. Now, the policy that guides the supply of money, the policy that guides the supply of money is called the monetary policy, okay? It is called the monetary policy. So the monetary policy, this is a policy that guides the supply of money, money supply, okay? That's the policy. It's usually followed by central bank. Now, you can see that the central bank, number one, supplies money, controls money supply, and it also acts as the banker's bank, right? Now, what we mean when we say the central bank acts as the banker's bank, we mean that this is the senior bank, okay? This is the senior bank, meaning all these other banks, the small banks, they are actually controlled by this particular bank. And that's what usually happens. So the central bank is in charge of all these other small banks, right? The commercial banks, yeah. The lender of last resort. Now, to be a lender of last resort, it simply means when these, you cannot go to the central bank to borrow money, okay? You can't go to get a loan from central bank. You don't do that. But what happens is that they send the commercial banks. For example, when Zanaco is bankrupt, or if they don't have enough liquidity, they don't have money. If they want to borrow money, they can go to the central bank and borrow at an interest, of course, they can borrow. So it is the lender of last resort. If the commercial bank has tried to ask for money from the public, maybe by issuing out the bonds, they have failed, then they really want cash, they want money, they can go and they get a loan from the central bank. And therefore, that is the reason as to why the central bank sits as the lender of last resort. It is the government bank, okay? It is the government bank, and it is the one that is involved in the management of the public debt, the central bank. Let's now try to dive in a bit and look at, let's get a little bit deeper and look at the monetary policy now in detail. Let's look at the monetary policy. So I already said that the monetary policy is the policy that guides the supply of money, right? So the monetary policy is the government policy that is conducted by the central bank, okay, to influence the supply of money and the level of economic activities. Now, there are some of the tools, and this is very important. You need to pay attention to, let me use the blue marker since we have read. You need the tools that the central bank uses as they control money supply. Very, very important. Number one, it is called OMO, right? OMO, the open market operations OMO, and the reserve requirement and the discount rate. These three of them, they are the key tools that the central bank uses as they control the supply of money. This entails that there is some time when we have too much money in circulation, or when we have too much money in the economy. And you know that having too much money in the economy is also dangerous to the economy, as you are going to see very soon. It is dangerous to have too much money in the economy. That pushes the price levels, you have inflation, you have all those problems. So the central bank is actually mandated to control the supply of money, to basically ensure that we do not have too much money in the supply. We just have what is necessary, the amount of money that is necessary to be in circulation. So you need not too much money, and you will not need too little money. So when we have got too little money in the circulation, in the economy, the government comes in, all right, through the central bank. The central bank will need to supply more money in circulation because of little money. And again, when you have too much money in circulation, the central bank will come in and reduce the supply of money, reduce some money in the economy. And so the tools that they use as they control the supply of money are as follows. Number one, the open market operations OMO. Number two, the reserve ratio. And from the reserve ratio, we have the discount rate. This time around, I call for questions to just check if people are following. Do I have any question so far? Any question? Are the people following?
Yes, we are following.
We are, sir, we are following.
Okay, okay. Hopefully I'm not speaking so fast, isn't it? People are following.
Yes, we are following, but is it possible you can just shed more light on where you said bankers bank?
Oh, the bankers bank. Okay,
Yes.
Thank you. So what we mean when we say the central bank is the bankers bank, it's the senior bank, okay? It is the bank that controls all other banks, the commercial banks. These commercial banks, such as maybe any First National Bank, FNB, Zanaco, Standard Chartered Bank, all those APSA, all those things, right? Okay, those small commercial banks, the commercial banks, they are controlled by the central bank. It is a senior bank. So it is the one that controls and monitors them. All their actions, or whatever they do, their trades are monitored by the central bank, being the chief bank. Is that clear? Is the questionnaire
Mm.
fine?
Yes, sir.
Okay, great. Let's start looking at them now. First, one by one. We start with the open market operations, OMO. The open market operation is the first two. It involves the central bank, the Bank of Zambia in this respect, buying or selling the government bonds and the government securities in the open market. Okay. You know the government bonds, right? Anyone who has an idea of what a government bond is, just to shed more light, we have to get understanding, not to memorize the notes. What is a government bond and how does it work? Anyone?
Sir, is it a treasury bill?
Yes. Come again.
I'm saying just a try. Are the government bonds? Are they treasury bills?
They are not the treasury bills, really.
Okay.
Yeah, but they're just more like them. There is just some minor difference that I should be able to highlight. How does it work in short? How does it work? We need to get understanding. We should know how it works. I think that's the most important thing. Okay, so the government bonds, how they work, let me start from the treasury bills. There is the time when we want to, for example, reduce the supply of money. The central bank wants to reduce the supply of money, right? Okay. If the central bank wants to reduce the supply of money, they sell the bonds. Now, selling the bonds, what it means is that when the central bank has started selling bonds, they call the public. Please, you guys who are in the public who have money, what you do, bring your money here. When you bring the money here, we are going to give back your money after so and so years, or maybe after 2 years, it will mature, your bond will mature. So every month, maybe after 2 months, we'll be giving you such an amount of money. So bring such an amount of money, we'll give you back the interest. Maybe it's 10% interest, okay? Maybe it's 12% interest. I'm just using examples, but usually the interest rates are low for the government because it has no risk. When you invest in the government bonds, those government bonds, they are denominated in local currency. So therefore, the government does not default. It can't default. They can always give, as a result, the rate is usually small. So they say, okay, can you deposit whatever amount that you're going to deposit? Then in return, we'll give you 10% interest. So you get your money that you have, take to the central bank to buy a treasury bill, okay, or get a bond. The difference between a treasury bill and the bond is that the treasury bills are short-lived, 3 months, 6 months, 9 months, they're usually less than a year. Then the bonds are for years. They work the same way. It's only that for the bonds, it's years. It's after 1 year, like 2 years, 3 years, 5 years, 10 years bonds, okay? So you take your money there. Then they will write somewhere, more like a receipt, to show that they have received their money and they are going, it's a promissory note. They promise you that we are going to be giving you the interest, we'll give you your money. And you just receive that, you copy those writings, you keep back, you leave your money there, okay? That is what it means. And that's how it works. When the maturity day comes, they give back the money with an interest. So now, when the central bank wants to reduce the supply of money, they sell the bonds, okay? And they increase the cost of borrowing. The cost of borrowing. It's not, by the way, it's not you to borrow from an individual cannot borrow from the central bank. The commercial banks are the ones that borrow money. So they increase the cost of borrowing so that it is very expensive for the commercial bank to borrow money from the central bank. As a result of that, the commercial banks will not go to the central bank and borrow money. Then that reduces the supply of money in circulation because you deal with the commercial banks. So they will not have enough money. And at the same time, the central bank will sell the bonds. As they sell, they will be they will sell the bonds. You will be buying the bonds as the citizens. You'll be using the money that you have to buy those bonds, right? So you give your money back to the central bank. If the central bank wants to increase the supply of money again, they buy the bonds, meaning they give you money. Okay, they buy back those bonds. So they start buying the bonds, they buy corporate bonds from the big companies, they're just giving out money. As they buy, they use money. So they're dishing out the money into the economy. And that is how the open market operation OMO works. Any question? Is that clear?
Yes, sir.
Basa, you are clear, you can move on. And so this is what usually happens, okay, with the there are two types of the policies, the monetary policies divided into the expansionary fiscal monetary policy and the restrictive, which is also same as the contractionary monetary policy. So under the expansionary monetary policy, if they want to expand, right, which means they want to supply more money, expansionary monetary policy simply means increasing money supply, okay? Increasing money supply is the expansionary, it means expansionary what? Monetary policy. And reducing money supply, it is what is known as the restrictive monetary policy. So when they want to expand the money supply, they want to increase the supply of money in the economy, they buy the bonds, okay? That's just a summary. Then the cash reserve of commercial banks increase. They increase the reserves, okay? They just increase the reserves of the commercial banks so that the commercial banks can loan out. Remember, the commercial banks use the reserves to give out the loans. The bank deposits increase and the credit is easier and cheaper. They lessen the cost of getting a credit. You can easily get a credit from the government and the aggregate demand rises. Then when they want to contract the economy using the money supply, they sell the bonds. As a result of that, the cash reserves of commercial banks will decrease, the bank deposit will fall, and the credit becomes very difficult and expensive. It is no longer cheap to get a loan. Once that becomes the case, just know that the central bank is trying to restrict the supply of money. Clear?
Yes, sir.
Yes, sir.
Okay. The other tool that the central bank uses is called the reserve requirement. The reserve requirement, okay? The reserve requirement, just as I did indicate, the central bank is the banker's bank, right? It is in charge of these other commercial banks. So it dictates or it says some fraction of money for every deposit that should remain at the bank, for every deposit that has been made. That is called the reserve requirement, okay? They do that by mentioning the reserve ratio. They will say, for example, the reserve ratio is 20%, right? Which is 0.2. Now, if they say, the central bank says to all commercial banks, the reserve ratio should be 20%, it simply means for every amount that you deposit, 20% of that money should remain at the bank. It should never be sent out as loans. It should not be given out as loans. The idea is that that money that should remain, that 20%, it should be the one to meet the demands of those that are withdrawing so that they are able to withdraw. Practically, and in most cases, it's rare that a person can make a deposit today and withdraw that same amount. It's not usually the case. So usually when people deposit, they leave that money for some time. So what the banks do, the commercial banks, they get that same money, that other fraction that remains as the reserve, and give out loans. Usually the banks, they use your money to make money. Those loans that the banks give, that is not their money. They use the money from the public, okay? From the public to give out loans so that they can make more money again from your money. And that is how it works. Okay, so now what happens is that I just said that the reserve requirement refers to the asset or the money balances that the commercial bank should keep in reserve, okay? So if the central bank wants to increase the supply of the money, they reduce the cost of borrowing. As a result, it will reduce the reserve requirement ratio. The reserve requirement ratio becomes what? Cheaper, it becomes smaller. Once the reserve requirement ratio becomes smaller, it means only a small amount of money, whenever you deposit, should remain at the bank to meet the demands of the withdrawals. Okay, just very small amount of, which means the fraction, the remainder should be given out as what? As loans. So when we reduce the reserve requirement ratio, it means we want more money to be loanable funds to go out in circulation. And so if the central bank wants to reduce the supply of money, they increase the cost of borrowing, and that will increase the reserve requirement. If we increase the reserve requirement, it simply means we want more money to be remaining at commercial banks than the money that goes out in circulation via loans, okay? We're saying we are reducing the amount of money that the commercial banks are giving out as loans so that more money should remain there at the central bank, okay? So that is how the central bank uses the reserve requirement to control the supply of money. Clear? Hello.
Sorry, sir.
Yes, sir.
I just didn't get it on the cost of borrowing.
The cost of borrowing.
Yes, on the cost of borrowing. Maybe you can just repeat.
Okay, thank you. The cost of borrowing, it is the interest rate that the commercial banks, okay, that the commercial banks charge or get charged for borrowing money, okay? Like when you get a loan, you're going to pay back, right? There's an interest that is charged. So when you say they have increased the cost of borrowing, that interest to pay back increases. It is usually increased. So once that is increased, it means that more people will not go and get loans, right? If many people have not gone to get loans, it means there will be less money in circulation because it is that money from loans that goes into circulation in the economy. Is that clear?
Yes, sir, very clear. Thank you.
Okay, great. Let's look at the discount rate. Now, the discount rate refers to the interest rate at which the central bank provides loans to the commercial banks. Very important. The discount rate, it is the rate that the central bank charges the commercial banks for borrowing. When the commercial banks want to go to the central bank to borrow, to get a loan, the commercial bank charges some interest, right? That interest rate is called the discount rate. Clear? And now this is what happens. If the central bank wants to increase the supply of money, they reduce the cost of borrowing, okay? Which means it becomes very cheap for central bank to borrow, for commercial banks to borrow from the central bank. It becomes very cheap. And that will reduce the discount rate. When the discount rate becomes smaller, okay, it becomes very cheap for commercial banks to borrow, which means most of the commercial banks will go to the central bank and borrow money. And that money that they are borrowing so that they can issue out the loans. And in the words of the father of economics, one of them, Adam Smith, writes in his book, The Wealth of Nations, and I quote, "It is not by the benevolence of the butcher or the brewer or the baker that we should expect our dinner, but it is out of their own regard to their self-interest." So what usually happens is that whenever anyone in the world of business is doing good, don't think people do things because they love you. No, they just do it for their own interests. Even those central banks, when you go, the commercial banks, when you go there, the way how they treat you, don't think they love you. It's not really out of love, and out of care. Okay, they just do it because you're going to leave the deposits, you leave money, they use that money to give out loans and make more money. That's the idea. But I'm I'm just I'm just joking anyway. But usually that's what happens practically. Adam Smith, the father of economics, said that, and it is true. So people don't usually do good because they want us. They do good because they have seen something, like they want something in return, yeah? And that is what was laid it's laid down in 1776 by Adam Smith the Great. If the central bank wants to reduce that was just a pass by comment anyway. If the central bank wants to reduce the supply of money, they increase the cost of borrowing and increase the discount rate. So it becomes very expensive for the commercial banks to go to the central bank and borrow money. Clear? So the expansionary monetary policy, MP, is aimed at increasing the economic activities in the economy, okay? Once we embark on the expansionary monetary policy, the idea is to increase the economic activities in the economy. It is achieved by buying bonds, okay? Reducing the reserve requirement, lowering the discount rate. And that is what usually happens. And the following are the effects of the expansionary monetary policy. If you increase the monetary policy, to increase monetary policy simply means increasing supply of money, okay? Once you increase the supply of money in the economy, this is what happens. Number one, the interest rates reduce, the aggregate demand or GDP increases, the investments increase, the consumption increase, the exports increase, and the income increase, the output, the level of output increases, which is same, those are same things, the output, income, aggregate demand, they hinge around the gross domestic product, GDP. And the E, which is the employment increases. So many people get employed when you use the expansionary monetary policy, when we supply more money in the economy. Of course, we are not saying supplying more than necessary, only ideal quantity. Because if you supply too much, you know what will happen later. Those are conversations that will hold when you look at inflation and the negative effects of inflation. Just have enough money in circulation. It helps to have all these results. And these are the effects. I ran them through again. They reduce the interest rate. Increasing money supply increases the aggregate demand. It increases the investment. It increases the consumption. It increases the exports. It increases income and output. And it does increase the employment levels in the economy. Those are effects of an expansionary monetary policy. What about the restrictive or contractionary monetary policy? It is about selling bonds, increasing the reserve ratio, and raising the discount rate. And the following are the effects. When we reduce money supply, we have the following. Number one, the interest rates increase, the aggregate demand reduce, the investments reduce, the consumption reduce, exports reduce, income reduce, output reduce, and the employment levels reduce when you use a restrictive monetary policy. So you have to learn how to balance, okay? You have to learn how to balance these things. Anyway, you have that conversation under ISLM. When you look at the ISLM model, yeah, very soon, those that are going to further their studies around these same concepts. Okay. So that's what usually happens. So the supply of money is always constant. It's always vertical because it's exogenous. It's influenced by the central bank. Okay. It is not related to the interest rate, right? It's not affected. There's no relationship whatsoever. That's why you see that the supply of money is vertical. The curve is vertical. Okay. And so you can see that the supply, when you increase the money supply, and the supply curve shifts to the right because the supply curve has just the increase. So these are basically some of the things that happens. Okay. So now the price of money, just that we look at the price of money as we are drawing closer to the end very soon. The price of money, it is actually the opportunity cost of money, which is the foregone interest, okay? The opportunity cost of money people choose to hold, okay? That is called the price of money. Right. the demand for money is basically the quantities of money people are willing and are able to hold at alternative interest rates. Okay, that's the demand for money, the quantities of money that people are willing and are able, you are willing and are able to hold at the alternative interest rate, keeping all other factors constant. Okay, and the portfolio decision is basically the choice of how or where to hold the idle funds. Okay, where you invest, in short, where can you put your money, where can you hold that's portfolio decision. Now, there are some of the key influences that influence the demand for money, and the following are the motives, okay, that control the demand of money, or that influences people holding money. The first one is called the transaction motive. The second one is called the precautionary motive. And the third one is speculative motive. This time around, I call for any question. Is there any question before I comment on the factors that influence the demand of money, or that influence people wanting to hold money, cash, just holding money? Any question? Is there any question? Hello, am I logged out?
You are still logged in, sir.
Okay. Okay, let's look at the transactions demand, the transaction motive. So people want to hold money for the purpose of making everyday market purchases. That's what that motive is, the transaction motive. You want to hold to cash so that you want to be using that same cash, that money, to do the everyday transactions, okay? The purchases, you want to buy what? You want to buy tomato, you want to buy what? You know those things, buy. So you'd want to hold some money, okay? That's one of the motive. The other one is called the precautionary motive, the precautionary demand for money. This one says that people want to hold money for unexpected transactions or for emergencies. You keep some money, Chabe, for emergencies, right? You would not want to move with a pocket that doesn't have anything. You would want to keep something in the pocket or in the wallet or something, like just have something, okay? You'd want to hold some money. You do not want to convert all your money into investments where you just say, no, I kept my money in a house, I kept my money in this asset, I kept my money in shares. But what if right now someone says, we want to buy tomato, 100 kwacha. Then you say, no, I have to go and sell shares, or I have to sell house, or whatever. You know those things. But the idea is that you hold money, okay, for emergencies, with the purpose to meet the emergencies, those unplanned, emergencies. That's precautionary motive behind holding money. The other one is the speculative motive. This one states that people hold money for speculative purposes for later financial opportunities. The word speculate simply means it's more like planning. Okay, you are holding something because you are waiting for some better opportunities. Some people just hold money. They're like, okay, let's wait. Maybe there will be a better opportunity where you're going to invest this money, and they hold on money to wait for that time. Okay, so that is called the speculative motive. Why people hold money? Okay, so the economists have since identified 4 factors that influence the 3 Keynesian motives of holding money. These 3 I was talking about, they are called the Keynesian motives of holding money. They were first expounded in 1936 by John Maynard Keynes, one of the great father of modern economics. 1936, and so they are called the Keynesian motives of holding money. And the factors that influence them are: number 1, the price level, which is inflation, income, the interest rate, and the credit availability. Those are some of the factors that do affect. Okay, so what will happen is that if you have got inflation, you have higher price levels, people will need to hold the higher money balances to carry out day-to-day transactions. when things are expensive, people would want to hold on onto a lot of money so that they are able to manage to buy. Imagine all the things are cheaper, like they are cheaper. People would not want to hold a lot of money because they know that they can easily manage to do what? To buy. Income is another factor expounded by some modern Keynesian economists. They said that the more you have money, the more money you make, the more you would want to spend. So the more you spend, the more money you would want to hold. So those people that have got more money, they want to hold on to more cash. That is what is said. That is what was expounded, okay? So income, inflation, income influences, okay, the hoarding of money, right? It does influence, or it actually guides, or it lies as a pillar for the three Keynesian model, the three Keynesian motives of holding money. The interest rates, okay? The quantity of money demanded goes down as interest rate rises. There is an inverse relationship. When the interest rates increase, right? The interest rate, those are the benefits that we get by saving money, keeping money. So if the interest rates are raised, people will not be motivated to hold money. They would want to take their money to the bank, reducing the money that they hold. Okay, so that's why we say once the interest are increased, people would want to reduce it onto holding money. If the interest rates are reduced, then people would want to hold money because it is not enticing to go to the bank to invest or to leave the money when the interest maybe is 2%. Your money will earn only 2%. People would, let's just hold our money. There is no need of, you get it, right? Of taking our money to the bank. So that is how the interest. Credit availability, if you can easily get it credit, you don't need to hold on so much money, isn't it? But because the credits are not usually available, people are influenced to hold money, right? People are influenced to hold money because drama zivuta kupeza, and that is what usually happens. Yeah. So that is what is happening. So to generalize, we can say that if the interest rates increase, people hold less money, okay? And as the rate of inflation does what? Rise, people will hold more money. And as the level of income increases, people hold more money. As the credit availability increases, people hold less money. People hold less money when there are more credits available and when the interest rates rise. So that is basically the generalization of what is being talked about.